Hey everyone, thank you for spending part of your day with us today, and thank you for your support of Intuit. We appreciate it. As you reflect on our strong financial performance, it's driven by two primary factors, both of which are durable. One, our global AI-driven expert platform strategy, and two, a core set of financial principles that guide our thinking in terms of how we operate the company. These 5 financial principles have served us well over the years. They remain unchanged and are durable. To recap, our first principle as a management team is to deliver organic double-digit revenue growth. As you heard from all my colleagues this morning, we see plenty of opportunity for us to continue to abide by and deliver on this principle. Second, we aim to grow operating income faster than revenue. We want to make sure we are leaning into efficiency and operating leverage as we scale the business. This allows us to deliver margin expansion this year as well as over time. Third, we deploy our capital in a very disciplined way, whether it's looking at new product introductions, new services, potential acquisitions. We aim to get an ROI that is in excess of our weighted average cost of capital. Then 4, we return the excess cash that we cannot invest at our acceptable thresholds back to you. And we have a strong track record of doing that through dividends and share buybacks. Finally, we operate the company with a strong investment-grade balance sheet. We want to make sure that we are operating into it from a place of strength, regardless of the macroeconomic environment. When you look at the growth, here's what excites us. We have a massive $300 billion addressable market in which we are only 5% penetrated. And these large end markets are ones where we as a company are uniquely positioned to win. The strategies you heard today, the product innovations you saw today are all keys to unlocking this opportunity. And underneath each of those strategies and each of those innovations is a robust AI-driven expert platform. The scale of our platform with 100 million customers globally, the breadth of our assets, the depth of our data, are significant differentiators. They allow us to deliver unparalleled customer experiences and customer benefits, unlocking multiple avenues for revenue growth as well as margin expansion. And this platform strategy has played out quite well. Over the last 5 years, our platform revenues have scaled at a 28% compounded annual growth rate. They were 53% of the company 5 years ago. They're 77% of the company as of the last fiscal year. And as we continue to lean into differentiated, frictionless, better together experiences, we see opportunities for us to continue to scale platform revenue over time. Let's take a look at how this played out in the most recent fiscal year. On the left-hand side are the objectives we shared with you last year at Investor Day. On the right-hand side is how we did. In summary, we delivered. Double-digit revenue growth, 13% total company, 14% platform. We grew operating income much faster than revenue, delivering both GAAP and non-GAAP margin expansion. We returned $3 billion to shareholders, including a 15% dividend increase. Let's take a look at how each one of our 3 primary business segments laddered up into this performance. Starting with the small business and self-employed group. This is our largest business unit. It accounts for over half of the company's revenue. And it grew its revenues at a strong 20% last year, normalized for the timing of the acquisition of MailChimp. Now, as Mariana shared, we are integrating MailChimp into our portfolio of online ecosystems, so we don't expect to report it separately going forward. But let me give you a couple of data points that highlight the scale of MailChimp. It surpassed $1 billion in revenue. It grew revenue 15%, grew paying customers 17%. Our small business group grew its total online paying customers 10%, grew ARPC 12%, and we made progress across each one of our key strategic pillars, giving us utmost confidence in its trajectory ahead. In a consumer business, we remain confident in our strategy and the path ahead, despite the unique tax season this past year. When you look at a normalized 4-year period to adjust for all the COVID noise, this business delivered revenues at a compounded annual growth rate of 10%, right in the middle of our 8 to 12% long-term expectations. And this last fiscal year, we saw multiple green shoots in our data that bolster our confidence in our ability to transform the assisted tax category with TurboTax Live. Data points such as TurboTax Live, revenue is growing 17%. TurboTax Live customers scaling 12%. Overall average revenue per return scaling 12%. As Mark shared, and I'll reiterate, we have the utmost confidence in our ability to continue to grow this business, given the opportunities to transform the assisted tax category, as well as the opportunities we have to deliver differentiated, better together experiences across Credit Karma and the small business group. And in Credit Karma, just a few minutes ago, Ken shared the $85 billion addressable market across the 3 key verticals. Even the largest vertical, we are only 8% penetrated. Ample runway for future growth. This business grew at a 25% compounded annual growth rate the last 3 years, highlighting its potential. And despite a challenging macro this past year where revenues declined 9%, we saw multiple data points which I regard as generating management alpha. We are seeing higher adoption of our platform. We're seeing higher adoption of our innovations such as Lightbox by partners. All of that is setting us up well to come out even stronger as the macro environment normalizes. And when you step back and look at this page, what it really highlights is the power of the platform. At Intuit, we run our businesses as part of one holistic platform. It is this approach that allowed us last year to deliver on each of our financial objectives despite the macro headwinds and despite a unique tax season. And as we look ahead, we see plenty of opportunities for us to continue to grow, given our clear strategies to win, as well as the multiple innovations across each one of our business segments. Our innovations are also scaling our ARPC. As we add more value to our products, and as we make it much more easier for customers to discover and adopt capabilities across our platform. Just walking from top to bottom, our online ecosystem in small business group, the ARPC continues to grow, giving the maturing customer base, given higher adoption of services, including services like MailChimp, where the ARPC is twice that of QuickBooks. And given faster growth in higher priced offerings like QuickBooks Advanced and QuickBooks Live. In the desktop ecosystem, we are seeing ARPC scale like customers increasingly adopt desktop enterprise, and as we price for value in a business that is now on a subscription model. Consumer group, ARPC continues to scale, given our success in transforming the assisted category with TurboTax Live. And again, we're just getting started. Credit Karma, we expect ARPC to scale going forward as we have higher adoption of our platform by consumers, higher adoption of our innovations such as Lightbox by partners, such as Credit Karma Money by consumers, and as we address the underpenetrated prime segment. Furthermore, as we bring Gen AI and Intuit Assist innovations to market, we are going to be opening up the aperture on monetization even further. To summarize what my colleagues shared this morning, we see 3 primary avenues for us to drive business upside and monetization through Gen AI. First, increase new customer growth and adoption of our services. Across each one of our business segments, we see significant opportunity for Gen AI to meaningfully improve the customer onboarding experience, to meaningfully accelerate the customer speed to first benefit, and to make it incrementally easier for the customer to discover and adopt new capabilities across our platform. All that leads to higher customer growth and higher ARPC. Second, we believe Gen AI will serve as an unlock to drive increased adoption of live expert help, which drives both monetization uplift as well as a competitive differentiation. Because we will make sure at Intuit there is no dead end with Gen AI on the customer's journey to getting 100% confident answer in the decision they need to make on our platform. And finally, we will test, explore, learn from customer feedback, opportunities for Gen AI specific do-it-for-you SKUs, while in parallel, we continue to abide by a long-standing tenet of pricing our products for the value that we are delivering. We're still early in this Gen AI journey, but we could not be more excited for the opportunities we see to deliver benefits for our customers and our shareholders. Shifting to investments, As the management team, we focus on durable revenue growth, but also a disciplined approach to how we invest in our business. Across each one of the expense lines, we expect them to be flat to down as a percentage of revenue over time, highlighting our focus on efficiency and operating leverage. Our approach to investments has not changed. We invest in the highest yielding opportunities that deliver durable revenue growth. We will continue to prioritize investments across our declared 5 bets while being disciplined and judicious about how we invest in our core innovation and run the business type expenses. And one of the advantages we have in driving operating leverage as we scale at Intuit is the way we are structured. We run our technology, customer success, and go-to-market organizations as platform-level capabilities across the entire company. So what that means is, in technology, we not only deliver higher developer velocity, we not only deliver accelerated time to market of our innovation, but we also deliver higher operating leverage when we build a capability once and we use it across the entire company. Capabilities such as AI, money movement, risk management, identity, to name a few. In customer success, we're leveraging AI and Gen AI capabilities across the entire company to drive efficiency as well as improve the quality of service we're delivering to our customers. And we're scaling a virtual expert platform across the company. We're learning, iterating, testing in one part of the business and scaling virtual expert platform in other parts of the business at a much accelerated pace. And in go-to-market, we're making investments in MarTech, sales tech, and billing capabilities that allows us to significantly improve the customer acquisition cross-sell funnel better than it's ever been in our history. All of this is a structural advantage we have at Intuit. Multiple businesses, one platform. And as we scale our operating income, we also scale our free cash flow. You can expect us to continue to have an exceptionally disciplined approach in terms of our cash flow. Last year, we returned 60% of our free cash flow to shareholders through dividends and share buybacks. And we will continue to lean into this same disciplined approach. And we're pleased that the board approved another 15% dividend increase for fiscal 24 on top of the 15% we did last year. And we consider share buybacks to be a key form in our toolkit of returning excess cash to shareholders. Our approach to buybacks has not changed. At the most, we will use excess cash to do buybacks using what we call a smart grid framework. This framework, in essence, guides our thinking in terms of how many shares to buy at different stock prices, with the goal, on average, to deliver a return that's higher than a cost of capital. And at a minimum, we expect share buybacks to offset dilution from stock-based compensation over a 3-year period. Subject to market conditions, we expect to be in market each quarter doing buybacks. At the start of the day, Sasan highlighted our operating system. It is one of our core strengths as a company, and it's also a strength when it comes to helping us deliver on our business commitments. As part of the operating system, we look at external and internal data. We debate the implications to our business, long and short, and we stay nimble in our execution. And one of the advantages we have is that we are seeing data of 100 million customers across the globe make financial decisions on our platform. That gives us a set of leading indicators that informs our nimbleness when it comes to execution. And we have a playbook as part of our operating system that guides our thinking in how to operate Intuit in good times and challenging times. The first principle, always do the right thing by the customer. We want to make sure our customers know we have their back, particularly when times are difficult. And second, we manage the business for the long and the short. We continue to invest in durable growth drivers while being disciplined about our discretionary spend to preserve the earnings power of the organization. This playbook served us well last fiscal year. Given the headwinds, we were still able to deliver double-digit revenue growth. We were still able to deliver margin expansion. And we were still able to bring significant innovation to market, including Intuit Assist. Looking forward, we are pleased to be guiding double-digit revenue growth, 11 to 12% at the company level, including 16 to 17% for the small business group, which represents nearly 60% of the company's revenue. This guidance is absolutely consistent with that which was shared at the August earnings call. And given the uncertainties we continue to observe in the macro environment, as I shared on the earnings call, we're taking a prudent approach to guidance for fiscal 24. We're also pleased to be guiding operating income and EPS growth faster than revenue growth, leading to margin expansion in fiscal 24, and highlighting our focus on efficiency and operating leverage and unit economics as we grow the business. And finally, we remain confident, given all the clear strategies to win, all the innovations, all the green shoots in the long-term potential of each of our 3 primary business units. We expect Small Business Group to deliver 15 to 20% over the long term, Consumer Group 8 to 12% over the long term, and Credit Karma to deliver 20 to 25% over the long term. In conclusion, here are the 3 things I want you to remember from our conversation. First, our financial principles are durable, and our objectives for fiscal 24 are consistent with them. 2, we emerged from fiscal 23 in a position of strength despite the headwinds, and our confidence in our future trajectory has been bolstered. And 3, our AI-driven expert platform strategy sets us up in an unparalleled way to deliver customer benefits, unlock our addressable market, and deliver durable revenue growth and margin expansion. With that, thank you for your time, and I'm looking forward to meeting many of you and keeping you apprised of our performance over time.